The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rout in chip stocks, a rebound in software, and another record high for emerging markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic.
And I'm Bailey Lipschultz. We're kicking you off to the closing bell here in the U.S. with a sea of red, at least in the U.S. equity market. S&P down about 0.5%. This all does come after earnings, didn't live up to expectations from Nvidia, down 5%, on pace for its worst day if it closed there since April. So a lot of red and pain in the semiconductors index as well. The SOX down 3.5%. If you're keeping an eye on those U.S.-Iran talks, crude back down 10 cents, still sitting around $65 a barrel. So it was trading higher when there was a little bit of uncertainty. Now some of those jitters calming. So a bit of a, call it sell-off, or at least flatten crude. But Romain, nonetheless, a lot of red if you're an equities trader or looking at some of the hardware as it relates to AI on the back of Nvidia's print. Yeah, exactly. When you look at a 73% jump in revenue for the world's most valuable company, and that fails to lift the market, well, maybe that is a sign that the 3-year AI beta trade has indeed run its course. Investors today souring more on chip stocks and finding actually some bargains among the software names. This after dueling earnings from Salesforce and Nvidia last night that painted an ever more complex picture of the pace of AI spending.
The markets, the hyperscalers were priced to perfection when we were in most of last year thinking this AI rollout is going to be successful and quick. And I think it's the quick part that is looking very sticky.
Adding to that color palette, more earnings tonight from names in the AI race, including Dell, Intuit, Zscaler, NetApp, and Autodesk. But for now, the rotation to underweight tech and overweight things like materials, industrials, and consumer staples, that continues. The net effect, though, is that while the S&P is less than 2% off of its record high, its trading range, it's been skin tight this year. It's just 225 points from intraday peaks to troughs. Compare that to just the last 6 months of 2025, when that gap was almost 800 index points. Meanwhile, the HSBC strategist team saying that they've actually have their equity overweight rotating into emerging market stocks and local currency bonds, as well as into Europe. Citigroup strategists tilting the same. EM stocks today outperforming the S&P for a third straight month. European stocks on pace to outperform for a fifth. Ed Yardeni says that rotation could continue for months to come.
We've got what I call AI derangement syndrome. We've all gone from a situation where AI is all good, productivity enhancing, good for profits, good for the economy, to suddenly kind of a Frankenstein monster that's going to devour us. And I think that kind of extreme mood swing isn't going to last terribly long, but it could last through the middle of the year. And meanwhile, we have seen this beginnings of a great rotation into foreign markets, as you pointed out. We've seen a great rotation into sectors of the S&P 500 that certainly lagged behind during the rally we've had.
Ed Yardeni there. Let's go from a legend on Wall Street to maybe a legend in the making. Michael Contopoulos joining us to kick us off to the close. Deputy Chief Investment Officer at Richard Bernstein Advisors. Let's talk about these mood swings. Yeah. Is this just really just kind of that value play, that safety play, or whatever phrase we want to use for it?
Well, I think it's incredibly rational, first of all. What I always say, equity returns are really driven by a couple key things. Number one is profit growth. And profit growth throughout the world is actually quite strong. I'd rather own an area of the market that is growing earnings from 2% to 5% to 10% than own something with 12% steady state, which is what the U.S. is today. Today, you have declining earnings growth of tech, comm services, and discretionary from very high levels, but their growth rates are declining. The rest of the U.S. is actually in acceleration to some degree, but emerging markets, ex-China, Japan, Europe, they're all coming off troughs. Earnings growth is accelerating. And I think the market is finally waking up to that. And I think we're in the early innings of it. When we talk about the early innings, how much importance do we have to put on the weakness in the dollar and whether that continues for what would now be, like a fourth straight year or something? Yeah, I think the weakness of the dollar could absolutely continue. But I don't think it's a necessary condition to wanting to own non-U.S. positions. obviously, it's a great kicker if the dollar weakens further. But it's not necessary. At the end of the day, we saw the dollar actually strengthen a bit earlier this year, and international markets still outperform U.S.
Wow.
So it's a great tailwind should the dollar weaken. We think that there's scope for the dollar to weaken further structurally over a longer period of time, but it doesn't have to be a necessary condition for international to outperform.
And looking at international outperformance, over the last 4 months, MSCI World Index, excluding the U.S., returning about 13%, S&P only about 2%. When you're looking at that broadening, and we're in the early innings, that's a lot of alpha being generated in a short period of time. So what inning are we in, and where does this actually go if you were looking to diversify away from the U.S.?
Yeah, I think there's two ways to look at this. One is from a cyclical basis, and the other one is from a more secular basis. We care about both, although at RBA we really manage to the cyclical, and you can never let the cyclical get in the way of the secular. But I think there's some really big secular tailwinds that would suggest we're in the very early innings, like of a multi-year international outperformance regime relative to the United States. And that's really based on the idea that deglobalization, a lack of investment in productive capacity, infrastructure, commodities, et cetera, is all inflationary. And with inflationary dynamics, you should have higher interest rates rather than lower, quantitative tightening versus quantitative easing. You should have areas of the world that are more value-oriented, that are more inflation-sensitive, commodity-oriented. Those should all do really well. That's on a secular basis, and I think we're in the very, very early innings of that secular story.
But what's different now than post-April? I feel like last year it was like, oh, sell America, rotate into ex-US. I look at the chart at the end of the year, and it's like, well, maybe if you bought Mag 7, you're pretty fine.
Yeah, I mean, listen, I think it's, that trade did start last year. I think, again, that's largely driven for a number of reasons. One is the earnings side. The other one is that we think liquidity is going to be tighter than markets expect. And I think markets are starting to wake up to that. Core PCE in the U.S., which is what the Fed cares about, bottomed in April of last year. Just hit 3%. Mm-hmm. You have some of the easiest financial conditions ever, given where growth rates are, where inflation is, where the dollar weakness has been. And I think what's happening is the market's starting to wake up to this potential for tighter liquidity, higher rates, punishing tech, comm services, discretionary, the AI trade, and finding other areas of opportunity that are much cheaper.
I do want to talk about the AI trade, particularly when it comes to the outperformance and the idea that you're seeing more growth overseas, because there was a narrative afoot that, at least when it comes to the AI build out, that it was at least primarily a U.S. story. The idea that there are more tech companies here, more innovative companies, for whatever that word means, and the idea that the benefits of this, assuming they arrive, would accrue more to companies based here in the U.S. Do you not buy that?
No, so I think that's right. That last piece, Romain, if it arrives, is key. I think there's just tremendous uncertainty around what AI will ultimately mean to an investor. Mm-hmm. Maybe from a productivity perspective, maybe from on how we live our lives or manage our businesses perspective, AI could be transformative. We don't know, but it could be. Mm-hmm. But it's not clear yet that it's adding to any major degree of productivity, that it's enhancing profit margins or profits, driving revenue growth, et cetera. Instead, what we know is that there's tremendous capital being spent. There's tremendous amount of debt being borrowed to build out hard assets and infrastructure. And we do like those infrastructure plays. We love small and mid-cap American industrial companies. We think there's a place for them to do very, very well for a long period of time. Again, not just because of the AI build out, but deglobalization should benefit them also. But the actual tech complex themselves, the AI disruptors, so to speak, the hyperscalers, I think the market's waking up that these aren't going to pay immediate dividends, and the investment's massive.
So when we see that rotation, and we're primarily talking into international, I mean, is there a certain area that you favor? Because you could take your pick. I mean, EM stocks as a whole at record highs. The CAC, I think, is at a record high. Yeah. I mean, what the heck is going on in South Korea? They're having just a phenomenal run as well. The Nikkei, everything. Yeah. So, I mean, is there a place you pick and choose, or do you just do a blanket?
We were earlier in the year a little bit more invested in more developed markets, Europe in particular. We added to Japan and emerging markets ex-China just recently. We think that really everything ex-China has room to run here. Yeah. Latin America earnings growth is starting to look quite strong, and they have a fair amount of ability to ease interest rates. The real policy rates are quite high. You have reflation in Japan. You have European fiscal stimulus and earnings growth that's quite attractive. Valuations attractive in all regions. I don't think you need to be too picky. I think stay away from China, which we would view in the bucket of sort of expensive excess with poor earnings growth. And you can almost, be anywhere else ex-US and be pretty safe off.
Mike, always a pleasure.
Likewise.
Michael Contopoulos, Deputy CIO over at Richard Bernstein Advisors, kicking us off to the close here on this Thursday afternoon. When we come back, a closer look at tariffs, a closer look at the supply chain, and a closer look at techs. The CEO and founder of Flexport, Ryan Petersen, going to be joining us in just a second.
Plus, we'll follow up on earnings reports out earlier this week in the real estate space with the CEOs from Realty Income and CoStar.
And we continue our conversations with CEOs fresh off of earnings reports out of Tanger, the big REIT in the retail space. Stephen Yalof going to give us his take here on just what type of strength and opportunity he sees in that space. Stick with us. This is The Close on Bloomberg. Let's take a look at shares at CoStar, rebounding a bit here on the day, still down on the week. The company did provide earnings just a little while ago, 27% revenue growth in the most recent quarter, and a first quarter forecast of revenue of about $890 to $900 million. The high end of that range above street estimates. Andy Florance joins us right now. He is the founder and CEO of CoStar, and he joins us here in studio too. Great to have you here.
Thank you for having me.
When we talk about the real estate space, and more importantly, kind of like how you sort of look at what tools can be used to better assess what's going out there, whether you're buying or selling. Obviously, everyone's talking about AI. Is that a real function of what you're doing right now with your business?
It has. There's been dabbles at it, like chatbots connected to real estate portals, but we just released a completely native, deeply integrated AI solution called Homes AI, and it is what the wow factor you get the first time you get amazing answers from a Claude or a ChatGPT you're now getting in a real estate environment. So it's a vertical application specific to real estate with high quality imagery and real estate content laid over a whole series of LLMs. And so you end up conversing about real estate, neighborhoods, schools, houses, doing virtual tours through properties. And it's definitely a next level experience.
Where is most of your revenue coming from in terms of the source? Is that coming from the developers, the real estate agents, the customers? Who?
We did about $900 million a quarter, and it's coming from commercial real estate brokers, owners who want to get super high-end information. Some people call us the Bloomberg of real estate.
Oh, that's a lofty
and that's a very lofty thing that
right.
we try to achieve. But so we have a lot of people subscribing to our information platforms. We do a lot of risk analytics for banks as a service. We provide hotel benchmarking, so the hotels around the world use us to understand rates, profitability, that sort of thing. So we have a lot of information business, and then we have billions on the marketing side. So apartment owners, real estate agents, commercial owners pay us to market their properties on the internet.
And when you look at the ability to utilize AI, are you targeting younger generation, people who are typically going to, I don't know, Zillow or Homes.com to just see what could be for sale if they were able to make a purchase, or how are you able to maximize that?
I do believe there's faster adoption in the sub-30 set. And in particular, we're building these really nice virtual reality tools where you can fly around the exterior of the house, the neighborhood, you can move through the house, and you can real-time ask questions as you're flying around about the property. That is going to be adopted a little quicker by folks under 35. But it really works across the board. It's amazing. What we see is in the AI version of Homes, we get 4 times the usage if a person goes into the AI mode than if they're in that non-AI mode. And they actually submit 7 times as many leads to real estate agents if they're using the AI mode. And it's just because you are going way beyond just setting a filter and browsing listings. You're actually having an interactive conversation with the site and refining your search and asking questions about what kind of marble is that in the kitchen counter? Can I fit a California king bed in here? You ask questions you can't believe you can ask of a real estate portal.
Well, is the goal then to, in the long term, replace the buying agent? I'm just thinking if I can go to the website and get all the answers I want about the school district or what zoning is like, then I don't maybe need to go to my local retail.
Well, the real goal, our client in this is the listing agent. And listing agents sometimes are listing agents, sometimes they're buying agent. There's not a separate buying and listing agent. It's one person. So what we're focusing on is providing value to the selling agent and the homeowner to bring additional buyers into the property.
Yeah.
If I have one person show up to buy the property, it's a buyer's market. If I get 3 people to show up, it's a seller's market.
Well, I wanted to talk about what is the market right now. We've been talking about elevated mortgage rates. There was a headline today. We're back below the average mortgage rate, below 6% for like the first time since 2022. Are you anticipating that we're going to start to see more activity this spring selling season relative to the last 2-3 years?
Well, we definitely have.
And I'm talking in the residential space.
Yes, we definitely have built up inventory that we haven't seen for quite some time. We have a lot of people locked into 3% mortgages, which slows the market. But you have another dynamic that people aren't really talking about, which I think is most people, when they set out to find a place to live, don't have a preconceived notion, I must buy, I must rent. About half, 60% will either rent or buy. Over on the multifamily side of the world, you have the highest vacancy rates you've seen in decades. So you're up at 12.5% vacancy. You have about 1.8, 1.9 million vacant apartment units. It's about a 400,000 unit surplus. So the housing market's going to have a little competition this spring from the rental market.
Yeah.
It'll be interesting to see how that plays out. And
yes.
Once again, thank you to Andy Florance. He is the CEO of CoStar Group, talking all things real estate. But coming up, tallying the tariffs, Flexport CEO Ryan Petersen joins us next with more on the supply chain tech company's latest AI solution aimed at mitigating tariff turmoil. This is The Close on Bloomberg.
It's been less than a week since that landmark Supreme Court ruling striking down Trump's tariffs, and a lot of folks are now asking, where's my money? There's a lot of talk here about whether companies will return some of the tariffs collected. FedEx today saying that it will do that. Now, supply chain tech company Flexport is rolling out AI to cut through some of the noise of the tariff uncertainty. A new fleet of agents aiming to help companies manage customs and brace for those potential refunds. Pleased to say the founder of Flexport and the CEO joins us right now, Ryan Petersen. All right, Ryan, great to have you here. You must be a busy guy, maybe even a popular guy. I've taken a look at some of the refund trackers that you have on the Flexport website here. I mean, how much more do you need to put into this, assuming that we are going to start to see maybe potentially some of that money flow back?
Yeah, well, there's some uncertainty about the timing and the exact process for how to get refunds back from the government. But I have a very high degree of certainty that there will, in fact, be refunds. So we just need to know when and exactly how. We've built a tool that you can go to tariffs.flexport.com where we'll calculate your refund. And that's straightforward. We actually are able to take the data from the government of your entries, which is easy for you to get. And we just calculate and show you exactly how much money you get back. It's $160 billion in aggregate. So this is probably, I mean, it's one of the greatest bonanzas in history for the business world to get $160 billion back from the government, sort of unplanned. I don't think a lot of people were counting on this. So that's just like a great new opportunity for people. And then we intend to help you file the paperwork and make it really easy.
I am curious, though, overall, I mean, over the past year, I mean, in addition to the refunds, just trying to navigate the tariff environment. We've heard, obviously, so many stories of folks who are having things shipped from overseas and, you know, mid-transit, you know, they found out that, you know, the tariff rate on whatever those goods were went up. Are you anticipating that we'll get maybe a little bit more normalcy, or maybe not normalcy, but stability, I should say, in some of those rates, so we're not going to see at least the fluctuations that we saw last year?
It'll get slightly better. So IEEPA, which is the type of tariff that the Supreme Court overruled and said, hey, you don't have the authority to do this, that's the act of Congress that gave the president the most leeway, where he could just put a tariff on anybody. And he woke up in a bad mood, he just put a tariff on you. That he will not be able to do anymore. That's now ruled illegal by the Supreme Court. But he has many other levers. All of them require a little bit more thoughtfulness, for lack of a better word. Like the Commerce Department will have to launch an investigation into a specific country and sector. And you'll therefore have more notice that this is happening. Maybe it's a little bit more measured. But there are many other tools that the president and the administration have to continue to put more tariffs in. So it's not necessarily a huge amount of relief on a go-forward basis. But like I said, we do expect to get a refund for the IEEPA tariffs that were overturned by the Supreme Court that were paid over the last year. And then on a go forward, yeah, expect tariffs, but maybe slightly less volatile.
But Ryan, how does that get distributed? Is it something that takes weeks, months? Are we going to have more lawsuits that have to be filed and have courts and judges make decisions on?
Yeah, so it's going to go back. It has been sent back to the Court of International Trade, which was the first court where the administration lost the case. Now, the reason that I and others have very high confidence that there will be a refund is because the government, the Department of Justice, submitted a motion to the Court of International Trade, actually to the appellate court, which is the level above the Court of International Trade, where they said very clearly in plain English that if they lose the case, there will be refunds. So I think it's going to go back to that court. They're going to review it, but I think it's a slam dunk in my view. I'm not a lawyer, but you just read it. And then lawyers who I have talked to, international trade attorneys, have said, yeah, it's slam dunk. They're certain that they're going to lose the case. And then at that point, I wouldn't say anyone's guess, but there's quite a bit of a range of outcomes in terms of how long does it take. The government will be doing refunds if and when this happens via ACH back to the importers' accounts, which is novel. February 6th, until then, most refunds from the government were sent via paper checks, which is sort of crazy. Those were done. In fact, Flexport alone has done over 700 million of refunds, 900 million of custom savings for our customers over the last 5 years. So a lot of paper checks that have been sent out. Now it's moving to an electronic system, which the government is, I think, reasonably prepared to do. So it's more of a question of what paperwork you'll need to file to prove your case and get the money back. And that's what we plan to help people with at Flexport.
But what's in it for Flexport, Ryan? Like, at the end of the day, what do you do? How do you benefit from this?
A few ways. I mean, we're going to charge a service fee for processing this. And then, the importers that I've talked to, kind of addicted. The main way they grow their business is buying more inventory. So as they get money back in their business, I expect them to buy more stuff and ship it. And so we should see a growth in the business on that side of the house, too.
I do want to ask you just a broader question just about kind of what we're seeing in the supply chain, just beyond just what's been going on in tariffs. Obviously, the business you have kind of a nice, keen insight into economic activity. I mean, what are you seeing? Are you seeing any sort of major shifts in what people are buying, selling, the time it's taking to get things from one place to another?
Yeah, I mean, well, there's two big stories in logistics aside from tariffs. Tariffs the biggest story by far. But the other two big stories, one is the Suez Canal, which really gets underreported, but we haven't been using the Suez Canal for the last 2 years, the biggest trade artery in the world, and the ships have been having to go around. That's a really big deal. Security situation in the Middle East being the main cause there, or the main thing to follow. And then the other big story is the CapEx build-out that's happening in the data center world. I think there's 2,800 data centers being built currently, and that's a lot of air freight. It's driven up the price of air freight and more than made up for the loss of what's called de minimis shipping, where these kind of e-commerce providers were able to ship duty-free, and that went away under the Trump administration. But the air freight build-out of chips and servers and memory cards and everything else that goes into that has been quite a boom for the logistics industry.
All right, Ryan, got to leave it there. Always a pleasure. Ryan Petersen there. He's the founder and CEO over at Flexport. And we keep an eye on markets, counting you down to the closing bell. Stocks off the lows of the session, but the NASDAQ still deep in the red, down by more than a percentage point. The Philadelphia Semiconductor Index down almost 4. You're watching The Close on Bloomberg. 3:30 p.m. here in New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Bailey Lipschultz. Romaine, bit of weakness in the market after that Nvidia print.
A bit of weakness here, and it's raising a lot of questions kind of about the balance that we've been seeing in this AI trade. And one thing I thought was interesting that we kind of learned yesterday, particularly on the Nvidia side, was the idea of the rising costs that we've been seeing for memory chips, primarily DRAM, which kind of goes into everything, your phone, your computer. There was a report just out by IDC just a little while ago saying they're actually expecting contraction in the smartphone market about 13% this year, primarily because of those issues.
So there are issues that are knock-on effects. So it's not even just your data center build-out. It's, as you mentioned, smartphones and how that impacts Qualcomm and Apple and other companies that kind of benefit and have been leading the charge, if you will, over the last few years.
And we heard from HP Inc., HPQ, of course, the computer and printer maker, basically saying that that's actually going to weigh potentially on its forecast for the full year. Now, after the bell tonight, we're going to get quite a few earnings in the tech space, if you will, not the heavyweight names, but we are going to hear from Dell, which, of course, has been the darling. Apparently, Trump loves Dell. But, you know, the servers and the computers, I wonder how they're going to be affected by that. They said 3 months ago that they were already sort of facing some challenges there, so it'll be interesting to see what they say.
It'll be interesting to see what they say, and you're looking at a market that's been rage-bound. Even if you pull up the Dell chart, it's done nothing really so far year to date. So you're dealing with a market that wants to do something to either way, but we're just kind of drifting. Yeah, we're just standing there with the stick poking it, saying do something. Also pointing out a lot of software companies into it, Zscaler, NetApp amongst a few also reporting after the bell tonight. given us a lot of views, but want to look at our stock of the hour, which is Carlyle Group. Right now, shares up more than 5% as the asset manager's CEO Harvey Schwartz seizes on the firm's recent momentum with new 3-year growth targets, aiming to raise at least $200 billion and generate nearly $2 billion of fee-related earnings to boot. Joining us live is Bloomberg TV markets correspondent Norah Mulinda. Norah, shares are up today, but still down about 8%. What's the read from Wall Street on Carlyle?
Well, we've really been looking at this in the context of some of its peers, which we know it has been lagging. If you take a look at maybe KKR, looking at the performance of when the CEO, Harvey Schwartz, came in back in 2023, he's really been trying to chart a turnaround story, because back in 2022, we did see the abrupt departure of the previous CEO. There were a lot of concerns about the fact that this company wasn't actually keeping up with its competitors. It was too small to scale in the same way that some of the other big names were, but additionally, it had a lot of issues when it came to fundraising and other concerns that Harvey has really been trying to implement some sort of turnaround story here. So that's what you're seeing with this 3-year plan that he's laying out here.
Yeah.
And you really see a lot of attention on Wall Street as to whether or not they're actually going to be able to meet the mark.
And we should point out, it's a big shareholder presentation that they're making, and this idea of kind of where Carlyle kind of fits into that future. Did he articulate that?
Yeah, that's what they were talking about. I mean, we know that they're about to raise at least $200 billion in capital. They laid that out there. They also talked about generating $2 billion of fee-related earnings. But it's not just a growth plan. What I'm hearing from some of my sources on Wall Street is that it's also a credibility test. Just echoing what I was just explaining before about the fact that we're really trying to see whether or not they're actually able to kind of chart out a new pathway and actually keep up with competitors or even soar past them.
We've seen so much of a debate for alternative investors, DPI. Investors want to see some form of return. How did this conversation or this event address those concerns, though?
Yeah, that's what people are really keeping an eye on. I mean, that has been the concern, whether or not they're actually able to do that. There was a lot of discussion, too, about private markets. You're hearing that as well, thinking about the company going there. We've been talking a lot about the private credit space. But additionally, we're just talking about the fact whether or not they're able to actually hit these targets and scale meaningfully.
Well, what were these comments that I did see? Because he did kind of address some of these issues with regards to the BDCs, and I think in his words saying that maybe they weren't marketed properly, the idea that they were kind of billed as being semi-liquid, which might have been, a little fringe around the edges, let's just say. But it gets to this idea here that, you have a business, not just with Carlyle, but really this whole industry, that it's gone from being this niche sort of thing, 30, 40 years ago, to now being probably one of the most dominant players, certainly in terms of money flow.
Yeah.
And now they're kind of pushing into this wealth channel. They're pushing into a different sector of investors who are going to, if not want a little bit more liquidity, at least certainly want to be talked to in a way that's going to be different than the way you would go in and talk to a pension fund or a big institutional investor.
Absolutely. So you're hearing a lot of investors really being critical about what this company is saying, the language that's coming out. And this 3-year growth plan, they're really scrutinizing it and saying, hey, this is going to kind of be the determining factor if they're actually able to hit these targets and meet the mark. It really does show that they could be a front runner in this space. But if they don't, maybe it was a bit of an ambitious layout here, and it could just mean that they're maintaining and falling into this second tier space, if you will.
It's interesting just looking at some of the comments in the Bloomberg News coverage. Turns out the old economy is the new economy, leaning into things like industrials, healthcare, and financial services. Yeah. I thought all the rage was AI. And, you won't hear Thoma Bravo talking about software in this market looking more bullish, but just thinking about diversification from a deal-making perspective.
Right, and I think that that's also another situation, because when we were talking about the past and how we think about Carlyle historically before this new CEO came in, it was almost as if it didn't really have something that was really niche to really help it stand out amongst its competitors. And it's really important to see this diversification. That's what you're hearing the company continuing to lay out here, that they want to feel as though they're the place to go as in comparison to their competitors, and really making sure that they are diversifying what they're putting out.
It's kind of interesting, too. I mean, they're like one of the few kind of, private capital companies that are, at least the publicly traded ones, that are actually up here on the day. And I guess maybe that's a testament to what he said. But it also gets to this idea, too. We talk about the pressure that we've seen Blue Owl under, still down for another day here. And a lot of other names in that space, whether fairly or unfairly, getting dragged down in this idea that maybe folks don't feel there's enough transparency in what they own. They don't feel enough transparency in terms of the mark to market. And more importantly, they're a little bit of concerned here about, exit strategies, exit plans, and whether you're going to get your money back.
Yeah, I mean, this is certainly a bright spot in the midst of a lot of the red that we're seeing. I've been looking at some of the price target action on Wall Street. We see about 60% of Wall Street analysts actually have a buy rating on this stock. only one analyst with the sell rating. So the majority of the street still feels as though investors should be really thinking about this as an opportunity.
All right, Norah, Mulinda there with our stock of the hour. Taking a closer look there at shares of Carlyle Group as Harvey Schwartz addresses shareholders. Those shares up about 6% here on the day, up for a third straight day. When we come back, we're going to take a look at the media space on the heels of those results out of Paramount, Skydance, and Warner Brothers Discovery, and the bidding war that never seems to end. That's coming up next here on The Close. This is Bloomberg. All right, time now for our stock of the hour. Taking a look at shares of Paramount Skydance, at one point up at the most going back to November on the heels of its fourth quarter earnings report. But we also got earnings out of Warner Brothers Discovery. Of course, that's been the target of Paramount Skydance's eye. They actually reported, well, slight decline in revenue. The television network business down 12%, the studio business down about 13%. Overall, a 6% decline for the quarter. Chris Palmeri joins us right now, our man out in Los Angeles, to break down what's been going on here. I do want to start off first with the numbers out of Warner Brothers Discovery, whether that was a surprise to you to see that drop, and more importantly, what actually drove those declines in revenue.
Well, this is really a tale of two companies. So Paramount, which just did its merger with Skydance Media in August, has been cost-cutting aggressively, and you saw those results in their traditional TV business. You know, they have CBS, MTV, better than expected profits there. Warner Brothers today, exactly the opposite. It's just a shrinking company. They're having the same problems with viewers in traditional TV down, but they're just not able to turn things around. They got rid of the NBA this season, so revenue is down from an advertiser and viewers standpoint. So just really underscoring the challenges and really why the company is going to get sold.
And Chris, Romaine mentioned that both Paramount's film studio and streaming units were unprofitable, would benefit from that deal. What is your read on kind of how this latest update impacts the conversations around a deal?
It just sort of makes it more urgent. Now, part of the pitch for Paramount is that they can combine Paramount Plus with HBO Max. They can combine all those TV networks and cut costs, and that their film division, which also isn't so hot, would benefit from all those wonderful franchises, from Batman to Harry Potter and that. So that's the pitch that Paramount's making, and right now, although despite not intentionally so, Warner Brothers seems to be making the case for them.
Yeah, it's kind of weird to see their film business down that much. I mean, I'm looking at some of the movies they had. Minecraft, wasn't that one of the highest grossing movies of last year? Sinners, which obviously looks like it might have a bit of an Oscar sweep coming up in a couple of weeks, one battle after another, which personally I thought was awful, but it seemed like it did well. It gets to this idea, though, too, as to what becomes additive to Paramount Skydance here. I mean, I know they don't really care about the news, or at least we don't think they care too much about the news business here. And is Netflix really still willing to fight for at least the studio side of this business if they want it?
Well, a lot going on there, Romaine, and I'm with you. I'm Team Sinners in the Oscar Best Picture race. Well, part of the problem specifically for Warner Brothers was the fourth quarter. They didn't have all those movies in the fourth quarter. So that turnaround that we've been talking about there, it wasn't visible then. But in terms of Netflix, Ted Sarandos in D.C. today, meeting with the Attorney General, meeting with the Chief of Staff of the White House, making his case still for his merger, which I will note until otherwise noted is the only deal actually in place with Warner Brothers. Mm-hmm. We fully expect to hear news out of the Warner Brothers board shortly, probably tomorrow morning, where they say the Paramount offer is actually superior. Yeah. In that case, that'll trigger 4 business days for Netflix to respond. But all the posturing right now seems to indicate Netflix will respond.
Yeah, Chris, just looking at the chart, Netflix rebounding pretty sharply over the last 3 days. Is that a sign of investors maybe, as you mentioned, waiting for a response from Netflix? If there's more silence, that's maybe a signal to walk away?
It's 100% a signal to walk away. Investors have not liked this idea. They don't want Netflix to buy Warner Brothers. Netflix management has said, trust us on this. We've been in tough spots before. We think this is the right long-term strategy, but very unpopular with investors.
Chris Palmeri, our man out there in Los Angeles. Paramount Skydance shares having their best day since November. Caesars Entertainment right now having its best intraday move since 2022, largely coming in the last few minutes after the Financial Times reported that Caesars Entertainment, the casino owner, is weighing takeover offers, including a bid from Tillman Fertitta. This potentially sets the stage for a potential buyout of one of the biggest crowns on the Las Vegas Strip. We should also point out, Bailey, also seeing some big movements in names like Boyd Gaming, as well as Las Vegas Sands, also moving higher on this story.
And I want to call out that Fertitta is, according to our holders page, the largest holder of Wynn Resorts. So it's going to be interesting to see if this does play out as the Financial Times is reporting, what could look like, what those ambitions could look like, again, just given the relationship or lack thereof.
Yeah, and I mean, we talk about the legacy, the Wall Street legacy, if you will, of Caesars and the different owners and the other people who've tried to own it over the years. Quite a remarkable story. But there's a bigger story here as well about the health of the gaming industry in Las Vegas. Tourism overall, we should say, there's been a lot of hard evidence, data, as well, a lot of anecdotal evidence here that they've really been suffering. People just aren't gambling as much. International travel is down, and that's hurt. So you kind of wonder, too, what the strategy is for getting Caesars back up to its former glory.
And I think you might also lose kind of the glory of going to a casino and gambling. If it's $30 hands and you can bet on Kalshi or on DraftKings on your phone, maybe the allure of going on that big Vegas trip is no more.
That certainly has a lot to do with it. Right now, Caesar shares continue to move higher, now up about 20% as we head towards the closing bells. We're going to have a fuller breakdown of some of the moves that we've been seeing on this market. A conversation up ahead with Jason Hunter, technical strategy over at JPMorgan.
There's just tremendous uncertainty around what AI will ultimately mean to an investor. Maybe from a productivity perspective, maybe from on how we live our lives or manage our businesses perspective, AI could be transformative. We don't know, but it could be. But it's not clear yet that it's adding to any major degree of productivity, that it's enhancing profit margins or profits, driving revenue growth, et cetera.
And that was Michael Contopoulos, Deputy CIO over at Richard Bernstein Advisors, kicking us off to the close just about 15 minutes ago. Stocks have been on the back foot all day, despite the fact the majority of the stocks in the main indices are higher, but you're missing some of those big heavyweight names, and that includes Nvidia, which is down more than 5%.
Well, Nvidia is down 5%. We saw pretty much every semiconductor stock in the SOX trading under pressure. When you look at the MOV function on the terminal, Nvidia were 30 points to the downside. So as you can see, I'll call it a big sell-off as it relates to the world's largest company. And we're even seeing that hit out the Broadcoms, Googles, and Apples all under pressure for one reason or another. As we mentioned, we did have that report that maybe dinged Apple just a little bit.
And it's always kind of interesting, too, when we talk about the fact that obviously it's the biggest weighting. Nvidia is the biggest weighting out there. And you would think, a 70+% bump in revenue, a 70+% bump in earnings, and a 76% gross margin for a company that size would kind of be that thing that would lift all boats here. But it's not even lifting Nvidia, let alone the rest of the market. And it kind of raises the question as to whether this rotation that we've seen, both on a fundamental basis and on a technical basis, has now really taken over for that AI beta trade.
Yeah, and we track on our desk some of the technicals. I get an alert every time the S&P breaks above or below the 50-day moving average, and that feels like it's been happening every day. I get 5 or 6 alerts.
That's alerts out loud to your
alerts out loud. I get yelled
your
at.
desk mates.
My desk
really
yells at me. I yell at my teammates. It's the Bailey alert is what we call it. But we basically have been stuck range bound. I'm going to say since early October.
Yeah.
Doing nothing.
Well, let's talk a little bit more about that range here and what we're seeing on the technical side, and bring in Jason Hunter, head of technical strategy over at JPMorgan. He joins us here in Studio 2, counting us down to the close. And to Bailey's point, too, I actually do want to start on how tight the market has been, certainly on the S&P. But there's still been a lot of activity under the surface, and I'm curious as to what that says.
Yeah, so absolutely. So, as I've written about in our notes, anytime a broad index rally decelerates near resistance, which the S&P has, there's a big channel or a set of channels that really contains the market going back to the global financial crisis, the 2020 low, the 2022 low. All of those trend lines are somewhere in the 7,000 to 7,200 area, give or take. The market's decelerated below that, and you've seen a massive leadership change. Normally, from a technical perspective, that's a big warning sign. Yeah. However, this time it's unique. It's not a movement from the growth sector that was dominating the market into defensives, which is usually the real tell. It's actually been into cyclicals. Yeah. So if you look at, as early as late third quarter, you had base metals that had been range bound for quarters on end, even a couple of years, starting to pressure that range resistance. They eventually broke out in the fourth quarter, and that's what triggered this pro-cyclical rotation. Normally, there's large correlation between base metals, the global manufacturing PMI data, and a slew of other markets across asset classes.
Are there signs that this has much longer to go?
So I would say from a technical perspective, a lot of these markets have already hit our minimum objectives.
Okay.
Whenever this starts to kick off, the data itself on the manufacturing side is inertial. So once it starts to go, I like to switch to a trend following type of strategy where you just trail a stop underneath the market, whatever you're long, wait for that deceleration and distribution pattern to form, and then maybe you start thinking about getting out. But for right now, there's no sign of that just yet. For any of the sectors, materials, industrials, energy, or when you look at the base metals or across the foreign exchange markets, Aussie dollar, you don't really see that big distribution pattern just yet. So there may be more room to go there.
Well, I was told that the Nvidia print was going to be the thing that broke this market. Whether it went up or down, we're still sitting sideways. When you look at some of the potential factors in the near term, what are those events that are going to move the market?
Yeah, so I think from my perspective now, especially this pro-cyclical rotation has lasted as long as it has, does that start to make its way into fixed income markets? And that was really the underlying thesis for my whole year ahead outlook, was that you'd see this pro-cyclical rotation. Those are also the same markets that also are correlated to things like 10-year tips break-evens, inflation market. As that starts to move higher, do you then reshape the treasury curve where this pro-cyclical rotation eventually creates its own headwind, where the belly starts to cheapen, the market starts to think about a potential Fed pivot at some quarters ahead, maybe into 2027, and does that slow the pro-cyclical rotation? So far, you saw that initially from the fourth quarter into the first quarter, but last week, the week before, you started to see the long end and break-evens with that mean reverted sharply back into their fourth quarter ranges, which really derailed what I thought would actually occur. Maybe that's just a pause. I think it's more technical than a fundamental signal, let's say. But for right now, that pushes back the whole thesis that inflation expectations would rise and eventually stall out this rotation. As for the tech sector, it's been consolidating for a long while. There's been a lot of picking of winners and losers within the sector. But at the index level, if we use the S&P 500 Information Technology Index, it's still just chewing sideways in a range. It's done a good job of holding range support. So it's not that people are aggressively rotating out of tech into cyclicals. You're just seeing that sector broadly consolidate. Even things like software that's been under enormous pressure, that's down to levels where I think you're likely to see it start to base out and even start to see a mean reversion to the high side.
You mentioned a Fed pivot. What happens if we do see any pressure on the Fed? Right now I'm looking at the WIRP function. Next cut, call it September, October. What could shake that?
Yeah, so that's where I'll just look at the shape of the yield curve there. As a technician, I take my cues from the price action without trying to be too cute about what's the Fed going to do, what are they not going to do. So I'll watch closely the way the belly trades, the way the long end trades. Because I think the front end is pretty much glued to this 350 area, given what's already priced into the forwards. Now the question is, does the belly start to come under pressure eventually as they start to think about, oh, maybe there is a Fed pivot coming, and naturally the front end might move with that as they take some of those eases out of the forwards. Or if the belly's unwilling to reprice, does the long end then come under pressure, where you have this pro-cyclical rotation, a Fed that looks like they're not going to move to tighten, and does that start to just steepen the yield curve from end to end?
Yeah. Just real quickly, only about a minute left here, but are you seeing any sort of material, like kind of hedging, downside protection? It felt like a few months ago, even a couple of months ago, even though people were kind of skittish, you weren't really seeing that show up in the price action in terms of actually counter trades.
So I'll look to the VIX for that. And really the reality is the VIX is just a derivative of the S&P in many ways. You can explain 60% of it just looking at S&P price action. Every time the S&P's come down within the range it's been in, you've seen the VIX lift, but it hasn't gone above levels that would be alarming. And I think that goes to what the rotation has been. It's been to cyclicals. Even when the S&P was weak over the last couple of weeks, on those down days, materials and industrials were up for good parts of those days. So I think that's keeping probably anxiety a bit sidelined for now. I think if that cyclical trade does rotate out and the S&P goes down with it, that would raise more alarms.
All right, Jason, got to leave it there. Jason Hunter, head of technical strategy at JPMorgan. The VIX right now, right around 19, and really, if you ignore that big spike that we saw back in November, it's kind of been stuck up in that 20 or below range for quite some time. Stocks off the lows of the day. The NASDAQ still in the red. A full breakdown of all of today's market action and a push ahead to another slate of earnings starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Bailey Lipschultz in today for Katie Greifeld as we take you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on a very interesting day here in the market, Carol Massar, 24 hours removed from what were blockbuster results out of Nvidia, and well, just a few minutes removed from what is actually going to be one of its worst days in a while.
Yeah, pretty significant and definitely weighing on those major equity averages. Having said that, I keep kind of going to the S&P, which is down just shy of 40 points, and you really do have a lot of names, despite that overall average, more than 340 that are actually gaining ground today. We're going to get into some of them, but I actually had some good gainers to choose upon.
Oh, we're going to have to wait for
High
those.
Expectations.
I'm sure you'll have something to add. I count on it.
The big narrative is about, okay, what's happening with the AI trade. We'll actually get another check of that when we do hear from Dell after the bell today, and get an idea of what demand is going to look like. So we're expecting those numbers across, and that could help inform us a little more.
I'm also interested to see some of these software companies, your NetApps, Autodesk, Intuit, and a few others also reporting as well. And we're going to get round that out too with a couple of, consumer-facing companies, including one company that's been under pressure for a while, and that's Sweetgreen.
Yeah, we got a lot of companies that have been under market selling pressure, but the opportunity with earnings, Romaine, as you mentioned, to kind of right that ship. It'll be interesting to see what management teams say as these AI jitters hit at software companies.
All right, well, we'll get the closing bells in New York. We should point out the S&P actually basically opened flat on the day. It actually did very briefly dip into the green, but it's going to end the day. It looks like down roughly about 37 points as we wait for these numbers to settle. That's going to be a loss of about 0.5%. The NASDAQ composite going to lose about 270 points or 1.2%. The Dow Jones Industrial Average, we'll just call it unchanged on the day. And Carol, the Russell 2000 higher on the day by about 0.5%.
All right, as Romaine predicted, we do have some application software companies reporting into it, out with its results. Second quarter adjusted EPS, that's a pretty big beat, $4.15 a share versus the street estimate of $3.69. Second quarter net revenue, top line, $4.65 billion. That too was a beat. Street was looking for $4.53 billion. Second quarter adjusted operating income, $1.55 billion. Again, better than what the street was forecasting, $1.4 billion. And we are getting something when it comes to the outlook. Intuit still sees fiscal year revenue at $21 billion to $21.19 billion. The street estimate is $21.25 billion, so it looks like it's reining it in a little bit. And still sees fiscal year adjusted EPS $22.98 a share to $23.18. The street estimate is $23.19. Stock down 1.5%.
I'm really curious to see what they say on the conference call, particularly when it comes to the rollout of these AI tools that everybody thinks is going to hit them. They kind of flick at that in their release, talking about that they are, quote, in a new category of the intersection of AI and human intelligence. I guess the big question is, does that actually benefit them in the long run?
Right.
I want to take a look at what's going on with Autodesk. Shares of the company makes PC software, multimedia tools, fourth quarter adjusted earnings per share beat estimates. Shares up 3.2%. First quarter revenue forecast did beat estimates as well. As far as those numbers look, first quarter adjusted earnings per share coming in $2.82 to $2.86 is what that outlook looks like. First quarter revenue, the outlook there, $1.89 billion to $1.9 billion. That beat estimates of $1.84 billion. Look backward, fourth quarter net revenue coming in above estimates at $1.96 billion. Shares in the after hours bouncing around, but unchanged as of now.
Yeah, this is a stock, Tim, that's still down about 21% so far this year. So, again, earnings kind of giving investors something to chew on, but still not much follow through, at least as it relates to Autodesk, which is down, call it 2%.
All right, also keep an eye on NetApp. The share is up about 6% in the after hours trade. Data management software is the game. Adjusted EPS in its fiscal third quarter, $2.12 a share. The street was looking for $2.06. So a beat there in line on the revenue side at around $1.17 billion. The company says that for the current quarter, its fiscal fourth quarter, it sees revenue in a range of $1.8 to $1.95 billion. The low end of that range is right on the nose of the average of Wall Street estimates. The shares right now basically unchanged on that news.
I want to go back to Intuit because now we're seeing the stock actually rally more than 2% here in the aftermarket. We know it's been getting hammered, not in a good way, down about 40%
is
here.
Is there a good way to get hammered? Or explain, Carol.
All right. It's been a rough year in 2026. Stock's down about 40% so far this year. But let's go back because into it, again to the outlook, seeing third quarter adjusted EPS, it's a little bit light in terms of what the street's expecting. They are looking for third quarter revenue up about 10%. You can see stock bouncing around. Now it's down again, down. Now it's unchanged. So I think investors just trying to figure out good, bad, or indifferent.
I'm looking at Duolingo. The headline here, and shares are down, but the company authorizes $400 million share buyback program. Shares down right now by 14.7%. The company, for its outlook, one reason why the stock is down, first quarter bookings, $301.5 million. The estimate was for $332.1 million. So a miss there. The company sees first quarter revenue coming in at $288.5 million. That's shy of the $1.8 million that investors wanted to see. This stock has been under pressure. CFO change just a few months ago. Shares down by about 18% as we speak. Once again, 2026 bookings, $1.27 billion to $1.3 billion. The estimate was for $1.4 billion. We got the CEO coming on the program tomorrow. We're going to ask him about all this and more. Luis von Ahn.
What language is it going to be in?
He speaks a lot of languages, but we're going to do it in English because that's our limitation here.
It's going to be accountant language, financial language.
Well, going from languages to online marketplaces, I don't really know an easy way to pivot there, but Real right now up 5.7%. This came after forecasts for revenue beat expectations, sees 1Q revenue $185 to $189 million. The low end of that easily passing estimates for $182.2 million. Looking at first quarter EBITDA, adjusted EBITDA forecast, $11 to $13 million. Estimates were for $8.7 million, so a beat as it relates to Real looking forward. But again, another company that's been under pressure, down also more than 20% so far this year.
Computer and server maker Dell now crossing the wire with its quarterly report. The shares popping initially on the back of it. The main headline, the redhead on the terminal, is your fiscal 2027 forecast. Revenue in a range of $138 to $142 billion. The low end of that range is more than $10 billion above the average of street estimates. The street was looking for 126 and change. So a very bullish guidance here on the revenue side. When we look, go back just a little bit and take a look at the adjusted EPS in the quarter that just passed. The company also beat there, $3.89 a share. The street on average is looking for $3.52. It looks like revenue also beat in the most recent quarter. The company also, guys, says it's going to raise its annual dividend by 20%, boost its buyback program by $10 billion. A lot to unpack here in this release.
Yeah, some more in terms of the commentary and context from the company. Recorded AI orders of $34.1 billion in the fourth quarter, $64.1 billion for the full year fiscal 2026 in particular, surpassing 4,000 AI customers in fiscal year 26 with growth across neocloud, sovereign, and enterprise customers. And again, as you said, raising that annual dividend and that board approving that $10 billion increase in the share buyback. And the fiscal year 2027, company sees adjusted EPS of $12.90 a share at the midpoint. That's up 25%, Tim, year over year.
And just looking through the commentary in the release to get some more context, the company's vice chair and COO, Jeff Clark, says the AI opportunity is transforming our company. We closed more than $64 billion in AI-optimized server orders, shipped more than $25 billion throughout the year, and are entering fiscal year 27 with record backlog of $43 billion. Powerful proof that our engineering leadership and differentiated AI solutions are winning. Shares up by about 6% right now.
Yeah, and you talk about that revenue growth figure. Remember, just a few years ago, this was a company that was in contraction and certainly got a big boost from AI. I do want to turn real quickly to Block, ticker XYZ. A lot of drama surrounding that company. The company says it's going to cut 40% of its workforce and says that for the first quarter that we're in right now, it sees adjusted operating income in a range of $600 million, which is actually above what the street was looking for. The company did actually report earnings for the quarter that just passed, the fourth quarter, saying that gross profit did come in above estimates at $1.83 billion, and its segment revenue relatively in line with estimates at about $2.19 billion. But the key headline there is a 40% cut of its
Hold on,
workforce.
Romaine. When have you ever seen an announcement 40% cut to headcount?
I'm a little surprised by this. I'm actually looking through the release right now. I don't know if this has something to do with some of the drama that we've been reporting on about the future of this company, whether this is about productivity and AI. Jack Dorsey, of course, has not been very vocal about exactly what's been going on there. But we talk about a company that we know has been trying to go through some sort of restructuring. We have to find out the exact reasons why. But, I mean, you look at the investor reaction there, Tim. I don't know if you have a TV screen in front of you, but a 15% pop in the shares on that.
Well, when you're paying, when your workforce declines by more than 40%, your salaries are going to be going down. So I think that's probably one of the reasons why we're seeing that reaction right now. But yeah, we're going to have to dig into this more because that is a big head cut.
Yep.
Headcount cut announcement.
Big headcount cut.
Is that AI at work?
I don't know.
That's what the Bloomberg story says. Jack Dorsey's block slashes nearly half of workforce in an AI bet, but also want to talk. Sticking on AI, the information reporting a few minutes ago that Meta has scrapped their most advanced AI training chip. Stock's not really reacting, but says according to the information, Meta now is shifting their focus to less complicated versions. So they're kind of leaning into competing with Nvidia, maybe a little bit more complex than expected.
All right, and the AI parade continues. CoreWeave out with its latest results. The stock is lower in the aftermarket. CoreWeave fourth quarter revenue, $1.57 billion. That's a little bit better than the street estimate of $1.55 billion, but we're going to dig a little bit deeper into that one. 5.5% lower in the aftermarket. All right, guys, that's a wrap. Busy aftermarket earnings there and stocks on the move. That'll do it for us. Our cross-platform program, of course, it's called The Closing Bell. Bailey and Romain continuing there on The Close on TV, and Tim and I continuing right here on Bloomberg Business Week Daily on Bloomberg Radio. Guys, we'll see you again, same time, same place tomorrow.
A lot more to break down here on The Close. Stick with us. We'll be back in a moment. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bailey Lipschultz.
And I'm Romain Bostic. Closing out this Thursday afternoon for U.S. equity markets. A down day for the S&P and the NASDAQ, the Dow and the Russell. Kind of poking into the green on this day as you continue to see a bit of a rotation away from tech into some of those more cyclical sectors. That includes a lot of those names in the Dow Jones Transportation Average, and it includes a lot of names overseas. Take a look at the Korean benchmark index now at a fresh record high, Bailey.
Yeah, a lot going on, a lot of red and green on your screen. Looking at aftermarket performance after a slate of earnings, Intuit under pressure. Going to be interesting to see, though, what management does on that earnings call. All eyes are on how the company is addressing AI. Flutter, the parent company of FanDuel, under pressure, missing expectations in a really soft forecast. And want to call out Dell Technologies right now, up almost 7%, beating expectations and maybe breaking out of a range finally, Romain.
Yeah, and a big part of that, of course, is what they're calling an AI boom that they expect to continue to propel revenue deeper into the year. And that brings us to our top story of the hour, a focus on the state of tech, a focus on the state of AI, and more importantly, just where is the balance? The AI spend, it's relentless. Hyperscaling AI companies collectively forecasting $650 billion in CapEx this year alone. But of course, what benefits one side of the scale weighs on the other. You have computer company HP yesterday saying its full year results might be closer to the low end of the range, given the persistent and now costly shortage of that dynamic random access memory, the fundamental building block of pretty much all the technology you carry around. And just hours ago, researcher IDC, it projected a 13% contraction in the global smartphone market this year, calling the unprecedented memory chip shortage a crisis like no other. And then it was 3 months ago when Dell warned of rising memory costs and said it was actually working on its configurations and product mix to address the issue. Well, they just reported earnings, and they were good. And more importantly, they gave a forecast, and that was even better. Mehdi Hosseini joins us right now, senior equity research analyst over at Susquehanna. What was your first reaction here when you saw the results?
Yes, a surprise to the upside. Like you said, the earning guide for fiscal year 26 is definitely better than expected. We were all expecting gross margin pressure. Now, they are raising their revenue guide for the fiscal year by 12%. And the EPS guide is up by 12%, taking the midpoint. So the higher revenue run rate is definitely helping with EPS. But all in all, I am surprised to the upside, given the gross margin contraction that is not as feared into the print.
Yeah, looking at the results, company generating about $50 billion in AI server revenue in the current fiscal year, which ends in January 2027. You mentioned margins. What's the big story from this print at first blush?
Right. We have known for some time that the AI server margin is around 5%. I think everything around the AI server that is doing better than expected on the margin side. Now, what I want to hear from Michael Dell and the team is how are they planning for additional memory, including DRAM and storage, procuring those components into the latter part of 2026. Keep in mind that HPQ told us the memory prices are going up by 100% Q1 to Q2. And this would have a tail end impact on the cost structure for HPQ, Dell, and the rest of the peer group. And I want to know how is Michael Dell and the team are going to preserve and protect margin? And that's going to be the biggest item that we're all looking at into the conference call.
All right, Mehdi, we're going to let you go here. Obviously, an exciting time here, and it'll be interesting to see what they say on that call. Always appreciate you jumping on for us at the last minute. Mehdi Hosseini over at Susquehanna International Group. We need to move to some breaking news right now on Warner Brothers Discovery. The company now saying that Paramount's offer for the company is, quote, superior. Those headlines now crossing the Bloomberg terminal. Warner Brothers Discovery Board has determined that revised proposal that we were talking about earlier this week from Paramount Skydance is a, quote, superior proposal, and that Netflix now has 4 days to match it. It also says, though, just to be clear, that the Netflix merger agreement remains in effect. But again, Bailey, basically a 4-day clock now ticking into whether Ted Sarandos and company want to actually up and in some cases match Paramount Skydance's offer.
And just looking at the quick share reaction, Paramount Skydance right now up a little more than 2%. Netflix, interestingly enough, up 1%. So it seems like this saga that never ends is going to continue to live on for quite some time. And as you mentioned, this does come at an interesting time when we see Netflix management catering or at least meeting DC.
And I do want to just go through some of the language here, and we want to be as precise about this here too, because Netflix, the deal is still on the table. The company is still saying that the board of directors favors the Netflix transaction. What they're saying is that the terms of the Paramount deal, though, constitutes a, quote, superior proposal. So effectively what they're doing is they're putting the ball now back in Netflix's court. They will have basically 4 days to respond to this in one way or another. And then that, of course, would then form the basis, not so much for the board's recommendation going forward, but obviously what the shareholders would have to vote on later next month.
Yeah, and this is, again, a deal that we've been tracking. And just when you look at some of the sheer numbers, you do have the $7 billion regulatory termination fee that would be payable to Paramount Skydance in the event the transaction does not close due to regulatory matters. And that payment by Paramount Skydance of $2.8 billion termination fee would be required to be paid to Netflix. Again, Netflix right now breaking out up almost 2% in the after-hours trading.
A lot going here in the after-hours trading. We should point out block shares now up 20% in the after-hours. Dell up about 7%. Autodesk, NetApp also moving to the upside on the back of those earnings. To the downside, names like Flutter, Duolingo, and Zscaler and CoreWeave. A lot to break down. You don't want to go anywhere. We need to take a break, but we'll be back in a minute right here on Bloomberg. As we continue our focus on the tech trade, on the AI trade, and the millions of dollars that companies are pouring into advancing AI, and whether it actually might be setting themselves up for a trap as AI use skyrockets and requires more tokens per task, that cost per token declines. That's good for the users, but that does force AI platforms to shell out more just to retain those folks. One of those folks is Gautam Mukunda. He's the Yale School of Management lecturer and a Bloomberg op-ed columnist who has a great column just about this, your own personal experience in this, and maybe kind of give us the, speak to me like I'm a 6-year-old here, exactly kind of what exactly you found out as you were using this and what it could potentially mean for some of these companies.
Sure, right. So I'm working on my third book, and I wrote an outline to that book, and I looked at the outline. I was like, the second part is the weakest part. It just it hasn't really come together yet. And at the same time, I kind of wanted to basically teach myself how to use Claude as well as I could. So I fed the outline to Claude. I fed it a bunch of other research materials, and I said, give me your comments on the outline. And remarkably, it didn't just identify the weakness in the outline correctly, which would have impressed me even if that was all it had done. It then suggested a fix based on materials that I had written 10 years ago that said you can use these in such a way to fix this problem. So this is stuff that I created. It took something that I invented and came up with a use for it that had not occurred to me. I was astonished.
Okay, that's great.
No, but astonished. But where does this kind of end? What is the end result as we all kind of digested the paper that was released on a Substack over the weekend or Monday morning? Excuse me. What's the next step? Where does this end for you?
So I think the fact that these tools are so remarkable sometimes, right? I mean, equally, you can also ask one of these tools, I live across the street from a car wash and I need to get my car wash. Should I walk there or drive there? Quite often they will tell you they should walk there, right? Because they don't understand what's you're actually asking. The fact that these tools are, in some use cases, so extraordinary does not at all guarantee that the companies that invent them will make a profit from them. And that's what my column was about, because I actually think if you think about Clayton Christensen's theory of disruptive innovation and how it applies to this industry, these companies are actually in a lot of trouble.
Well, it gets to the, I'm also curious too, and because you kind of hit on this idea of inertia, and I know in the past, particularly with some of the industrial companies, got eaten by the tech revolution in the 80s and 90s. I know there was a pace there that was a lot slower. It was kind of like that steamroller, that proverbial steamroller, in the Austin Powers movie that's going, a mile an hour. This is like, an Acela train. Well, if Acela actually worked, an Acela train, coming at you at a couple hundred miles an hour.
This is generations happening in the blink of an eye.
Yeah.
And the thing that makes most worry about them because of this is that inertia is like bad management teams succumb to inertia. The problem with this, what's going to happen to them is that they're going to fall into the trap that good management teams fall into, right? Which is their use case, their valuation, everything about their companies drives them to push the technological frontier forward and to serve the most demanding users, the ones who want the highest performing AI systems. That is, as we're seeing, unimaginably expensive. These are, the highest sort of capital investment burn rates in the history of capitalism. The problem is at the same time that they're doing that, the tools that are behind the frontier are getting cheaper and cheaper and cheaper, and they're getting better. Yeah. And those tools have economic utility, but you can come in as an entrant, as a disruptive entrant. This is the actual meaning of disruption. Yeah. Market to those customers at costs that are vastly lower than any of the frontier labs can match, because they're paying $250 million salaries, and no disruptive entrant has to do that at all. Yeah. That's really scary, because you could find out that the customers who you actually should be making a profit from get eaten out from under you, even as you create these new technologies.
All right, Gautam, I have to leave it there. Gautam Mukunda over at Yale. We should point out, Intuit just reported earnings. They're down. The CEO actually speaking to Caroline Hyde, saying you can't disprove a negative when it comes to the AI disruption. But as Gautam points out in his latest column, disruption not just coming for software stocks, but maybe for the AI industry too. Bailey?
Pivoting away from AI and back to some of the breaking news out of Warner Brothers Discovery. Let's bring in Bloomberg's Lucas Shaw. Lucas, Warner Brothers coming out saying that the Paramount offer is, quote, a superior proposal. What do we need to know?
Well, Paramount's in the driver's seat now, right? This has been Netflix's deal. Warner Brothers agreed to a deal with Netflix in early December. Paramount has been trying to change that for the last 2+ months. They've submitted new proposals, they've revised them, they've tried to address Warner Brothers' concerns, they've been rejected again and again, but this is the first time where the board has said, okay, now you've done it, your deal is better, and Netflix has 4 days to respond.
Do we have any sense? I know there was reporting today that Ted Sarandos was supposed to be meeting at the White House, but when you look at the market speculation right now, it seems to be folks starting to pivot a little bit more to the idea that Netflix may actually lose out.
Well, look, Netflix shareholders have been against this deal. While the leadership of the company has insisted that's not the case, they don't like uncertainty. It's been pretty clear from stock reactions when various news has come up that the shareholders are worried both about Netflix doing this deal at all and how much they're going to spend on Warner Brothers Discovery. The question is whether the leadership at Netflix responds to that, or if they still feel that the deal is in the company's best interest. To your point and what you just said, Ted Sarandos is in D.C. right now. I think he's stress testing a little bit how much of a regulatory problem they would have if they increased their offer.
I just want to be clear, though, too, about this. Just because the deal is deemed superior doesn't necessarily mean shareholders are going to take it. Ultimately, they will be the arbiters. And the idea that the board is still saying to a certain extent, I think in their words, they, quote, favor the Netflix transaction. Can we read anything into that?
Well, to the first point you made, I think it highly unlikely that shareholders would vote against either of these deals. Considering where Warner Brothers stock was trading less than a year ago, or kind of before this whole pursuit began, this is a huge win for all of them, whether they get the Netflix deal or the Paramount deal. I think shareholders are a little split over kind of which of them they prefer. Paramount offers a little more certainty because Paramount's buying the whole company, whereas Netflix is only buying a couple of the divisions. And I think there's a belief that Paramount has a better chance of getting this through regulators, whether that's based in law or not. That's just a perception. There's been a theory that the board prefers Netflix, but that has not borne out.
All right, Lucas Shaw out there in Los Angeles. We should point out all three stocks, Paramount, Skydance, Netflix, and Warner Brothers, slightly higher in the after-hours trade. When we come back, we're going to talk about Block, up 20% in the after-hours session. All right, keeping an eye on shares of Block, up more than 20% in the after-hours trade after the company said it was going to slash its workforce by more than 40%. Emily Mason joins us right now to talk a little bit more about Jack Dorsey's project that has been through a lot of fits and starts, and now a company that is going to be leaner. Is that the idea here?
Yeah, I think Jack is kind of an innovator, and he really believes that he can run the business more efficiently with fewer people by leaning on like AI tools and just making them more efficient. So they've invested in Goose, which is their internal tool, and they're really planning on leaning on that a lot.
Is there a sense here, though, when we talk about what this company is trying to be? And I know there's been a lot of speculation about its future, whether there could be a potential buyer, whether it would be a buyer for something else here. Is there any way to connect the dots there?
I mean, I think it's hard to speculate on, like, PayPal's been the story this week. I think it's hard to say that they're going to swoop in and buy. I mean, it's always hard to tell with these things. I think based on this, it feels less likely, but that's kind of just me talking.
But does it seem like when you talk to management, this is a proactive move? Because at least if you were, I don't know, thwarting off an activist investor, you can say, well, we cut our workforce by 40%, so that buys us 9 months to turn the company around?
They're really trying to communicate that this is coming from a place of strength. Like, they're trying to highlight that they had a strong 2025. They've kind of increased their lending initiatives. They say that they're growing profitably, or they're growing their profitability. And they really want to communicate that this is coming from a place of strength, and that's kind of what's going on here.
I just want to clarify, too. I finally pulled up the Q4 shareholder letter. So they have about 10,000 employees, according to this letter. So basically, they would drop that to around 6,000, Bailey.
Which is a big drop. And again, this is a company that you go back to 2021. During the pandemic, it was trading $281 a share. Now it's at 55. I mean, Romaine asked, but like, what is the vision of Block? Like, if you were to talk to a Jack Dorsey, like, what does this company look like 5 years from now?
I think that's been something that investors have struggled with, and why the shares have been so reactive when earnings drop is because they talk about a lot of different things. Like, they also talk about their Bitcoin initiatives a lot, and people struggle to understand that and where it fits into the business.
I also want to just read something else in here, Emily, and get your reaction to it. I mean, he talks about, and this is, I'm quoting him, and he says his core thesis is simple, that intelligence tools have changed what it means to build and run a company, and basically a significantly smaller team using those tools can do more and do it better. He also says that he thinks a lot of companies are late to this. And I think back to some of the attrition that we saw in some of the big names like Meta and a few others over the last couple of years, where they kind of also publicly kind of said the same thing. They didn't make as dramatic of a cut, but this idea that technology had advanced enough, and maybe that they overhired too in the previous cycle, that they didn't need as many people.
And that's his point, right? Is he's trying to say, like, I think we got bloated. I think we need to become more efficient. Like, they have been kind of restructuring and doing rolling layoffs since at least 2024. And that's kind of where they're at. And, I hope that they're happy at this headcount and they don't have to let more people go. But yeah, he's making a bold bet.
Well, I think the interesting thing, back to the PayPal point, we see Stripe continuing to grow in the private markets. Is this a situation where if Block was private, these would be decisions made in a dark room that no one would really care to talk about?
I mean, I think it's hard to say how they'd act if they were private. I mean, they probably wouldn't come out and announce that they were laying off nearly 40% of their workforce. I probably wouldn't if I was running a private company. So yeah, I think it's hard to say, but they have to report because they're public.
Well, Block now, XYZ ticker there. This would actually set up, I believe, for probably one of the biggest one-day gains that they've had in quite some time. The shares up 23% here in the after-hours trade. Emily Mason, Bloomberg reporter, has the story on your terminal right now, a 40% reduction in the workforce at Jack Dorsey's company. All right, let's take a look at some of the other more notable movers in the after-hours trade. We've been talking a lot, Bailey, about Dell. I think there were kind of mixed expectations coming into this print, because remember 3 months ago, they talked about how higher costs were weighing on them. There was a lot of concern about the pace of the AI trade. But when you look at the numbers, not only for the quarter, but the relatively bullish guidance that they gave for revenue for the full fiscal year, that seemed to assuage a lot of fears here as to whether there was really any true speed bump out there.
Well, and this has been the debate, even when you look at Nvidia, was fine what you've done in the last 12 months, but what does the next 12 months to 24 months look like? Even the options market was pricing in a 9% move. Right now we're at 12%. I'm not a technician, but the 100-day moving average is at $132, so this would blow past that. And this is a company that really, for all intents and purposes, has been kind of drifting for the better part of 3.5 months.
It's kind of interesting to see what's getting left behind in the after-hours trade into it. We've been talking about that on the software space, down about 3.4%. And Zscaler also in the software space, despite the fact that it actually did beat expectations in the most recent quarter. But it gets to this idea of people are still wedded to this AI trade, but not necessarily to software stocks, or at least the stocks they think are going to be disrupted.
Well, the thing, you look at Zscaler, right, down 7.5%. It was up 17% in the last 3 days. So we're continuing to see some of these stocks that had been rallying over the last 3 days after this big washout trade that happened Monday. Even if you are not that far off from what Wall Street was looking for, if you're up 17% in 3 days, you're going to get dinged.
Yeah, Zscaler, one of the biggest decliners in the after-hours trade. Block and Dell, two of the biggest gainers. When we come back, we're going to focus in, take a little bit of a pivot here, and focus in on the retail sector, and particularly the real estate market in that space. Stick with us. This is Bloomberg.
We spent 30 years distinguishing between outlet and retail, and you'd go to the outlet for a deal, and you'd go and buy last year's product or made-for-outlet product. What we learned is Gen Z don't see channels, they see brands. Sometimes the quote-unquote outlet store is the best mall in their neighborhood.
That was a part of a conversation that we had with Todd Kahn. He's the CEO of the Coach brand, really talking about the value add from outlet shopping centers to that big boom that we've been seeing in Coach. Remember, we're talking about brand growth right now running around 25% year over year. Who better to continue that conversation with than the CEO of Tanger? It's the owner of and operator of outlet and open-air retail shopping destinations. Those shares popping this week after reporting earnings. Stephen Yalof joins us right now, the CEO of that company. Great to have you here.
Thanks for having me back.
And before we talk about specifically about Tanger, I do kind of want to talk about a Coach in general, and really just the idea of people returning to the physical retail space. And we didn't quite get it in that clip, but he talked a lot about the younger consumer, because I mean, there's kind of this perception that, oh, it's just, old folks, boomers that go there. But he said, it's Gen Z, even Gen Alpha, that's spending a lot more time in malls, in physical stores, because that's the shopping experience they now want. Are you seeing the same thing?
100%.
Yeah.
And Coach, it's a heritage brand. So it's not this brand new brand that just speaks to a younger consumer. It's been around for quite some time. And to walk into a Coach store in one of our shopping centers and see it packed with younger consumer is really inspiring for us as owners of shopping centers. It informs how we want to speak to our consumer, the media we choose, the digital initiatives that we're taking. So what Todd is doing is really, as a leader of that particular brand, is setting us all up as owners of shopping centers for great success.
What are you hearing from other brands and other retailers who are not just the legacy ones who maybe have always been in that space, but maybe some of the newer ones that are now starting to kick around that space, whether it is actual physical goods or maybe food and beverage and things like that?
Well, let's talk about the outlet space for a second. So the outlet space has just seen a surge of new brands that have joined. And whether they're formerly digitally native brands, so Rhone or Viore or some of the the athleisure brands that are now looking at outlet as a great place to interact with a brand new customer. And I listened to what Todd said, and he's right. The customer doesn't see channels; they see places to shop. And a lot of our shopping centers are shopping now far more locally. Outlet used to be a tourist sort of, it was something that you did when you were on vacation with your family. Now outlet centers, because of the population demographic shift, we see a lot of local customers coming.
And he also made a point there too, Bailey, during that interview that we had with him, that it's also not about discounting. Like, we kind of think about outlets, that's where you go just to get the cheap stuff. But he was saying that at least for them, they're actually holding price. It's more of a different channel rather than a way to just discount.
Well, if you want to get this customer to come shop with you have to give them experience.
Yeah.
That's what they're looking for. It's customer service could be part of that experience. I think what differentiates an online experience from an in-store experience is customer service. And the brands that are doing it best, like Coach, are the ones that are really winning at the cash register with the customer.
Well, when I was down in Florida at the ICR conference, every management team from Fabletics, you mentioned Roan, we saw Alo there talking about their need to invest in a physical footprint. Are those anchor tenants, or are those companies that can kind of fit into a mall that helps kind of supplement existing storefronts?
It's interesting. The word anchor as a tenant means a bunch of things. People think an anchor tenant is the biggest square footage user in the space. To us, the anchor tenant is really the halo tenant that drives in other customers. And Alo or Lululemon or Coach, although they might not have the biggest footprint in the shopping center, they really anchor that positioning.
Well, the thing that I found interesting during the holiday season, my wife was like a diehard Instagram shopper. She goes to the mall and she's like, wow, I didn't realize how many options Vuori had until I went to the physical store. So I guess I'm just trying to think through, are there regions that are more predominantly kind of leaning into the Gen Z shopper? Is it a coastal kind of, I guess, focus?
Yeah, I don't think so. I think that the brands want to be where the customers are. And, brands that have had a big online footprint have great information. They've got great data. They know where their customers are and where they shop, and can position a physical store in the geography where they're seeing a big pop in online consumers.
I am curious about expansion and just the kind of the fight for real estate. Are you having any issues in finding new real estate that at a favorable price, not only because of the potential competition from other folks in the retail REIT space, but also obviously a lot of industrial companies, data centers, other people also looking for basically any land they can get their hands on?
Well, yeah, and what's so interesting is there isn't a lot of new development of retail space happening across the country right now. So it makes every square foot of real estate in our portfolio more valuable. And I think our investors are recognizing that, but I think the retailers are recognizing that too. So we're able to grow rents off of that, but we're also able to merchandise and curate our centers. So the old standard retailers that have been there forever, some of them have lost a little bit of their market share. They haven't reinvested in their stores. And let's go back to Coach for a second. Coach has reinvented their product, reinvented their marketing campaign, and reinvented themselves to a much younger consumer that makes them so relevant today. Others who haven't done that, we're replacing them with new brands that they're making room for a lot of these new brands and products and categories that are coming into our centers.
Well, do you see what kind of brands are leaning into opening storefronts? Is it the Fabletics? Is it the Vuori? Or is it, I don't know, a Target that's expanding its footprint?
Well, in our portfolio, we're more boutique-y in that we go after much smaller stores than that. But what's interesting is that consumer that we're talking about, that younger cohort of consumers, is looking for food and beverage. They're looking for entertainment. So it's really incumbent on us as owners and operators of shopping centers to make sure that we're bringing in the uses that this customer wants.
Yeah.
We can market all day we want to a younger consumer, but if we don't deliver them the brands they want, the experience they want, the quality of service inside the stores that they want, and the restaurants and entertainment and amenities, we also have a loyalty program. And I think a younger consumer is looking for that gamified experience when they come and shop with us. They want to be rewarded for giving us their loyalty.
Todd said he's trying to open up more coffee shops. Has he talked to you at all about getting one in one of your
Absolutely.
Yeah.
So we're actually under construction right now with one of his in our shopping center in the Westgate Shopping District in Glendale, Arizona. So we're excited about that opening in the coming months.
Well, I'm just thinking through, when I was in 8th grade, I would go hang out at the outdoor mall in Southern California. So the mall is not dying in terms of a weekend getaway for the younger kind of Gen Z crowd? Like, I'm just thinking through, you mentioned coffee. People are spending money doing something.
Well, that's right. First of all, I think it's up to us as the operators of shopping centers to make the shopping experience and make the on-center experience exciting, amenitized, and rewarding for the customers. If the shopping centers that may be dying, and some of them are across the country, are ones that aren't investing like we're investing to make that experience, recognizing how important the experience is, and then investing into that experience.
And just real quickly, I think I ask you this question every time, but you're not seeing any real issues on the economic side with regards to not just people's willingness to spend, but their capacity.
Well, again, first of all, our full-price centers did really well in the fourth quarter. But more importantly, our outlet centers, which are on sale every day, speak to a consumer that's looking for brand, at value. And that's a really important part of that. So for Todd, he might be seeing a customer come into a Coach store at that opening price point, that outlet opening price point, and then convert them through his ecosystem and trade them up into his full price stores. So,
Stephen, always a pleasure.
It's great to be here.
Stephen Yalof is the president and CEO over at Tanger. Now we switch from the retail and real estate environment and back to Hollywood here. The never-ending saga between Warner Brothers Discovery, Netflix, and Paramount, Skydance Paramount, now out with a public statement here on the latest news that Warner Brothers now is saying that its bid, Paramount's bid, is the superior one. Paramount also saying that it has agreed to cut Warner Brothers' potential $1.5 billion financing costs. It also says it is now lined up $58 billion in debt commitments from lenders, including Bailey from Bank of America, Citi, and Apollo.
Yeah, this deal seemingly never ends. But again, we've been talking about this when the news broke. All three stocks trading higher in the aftermarket. Netflix at one point was up closer to 2.5%. So a lot of gaming out about what this ultimately means. As you mentioned, that 4-day clock ticking is something that we're going to be closely watching.
Absolutely. Here, we've all set our watches, and we're all waiting to hear what Netflix has to say. When they say it, you'll hear it here first, right here on The Close, right here on Bloomberg.
C-suite sentiment is surging. That's according to a new survey from the Conference Board and the Business Council, showing CEO confidence rising to the highest level since the first quarter of 2025, quote, reflecting restored optimism among leaders of large firms. For more on that, we're going to bring in Yelena Shulyatyeva. She is the senior U.S. economist at the Conference Board to discuss. All right, Yelena, this was before the tariffs were rolled back, but nonetheless, CEOs optimistic, though they did see increased costs and we're planning on passing that along to consumers. What's the takeaway from the survey and kind of what does the tariff rollback mean?
Absolutely. So the cutoff for the survey was February 16th. So obviously it's a little bit outdated relative to what happened after that. But nonetheless, it's very nice to see that CEOs are becoming a little bit more optimistic. So the survey asks CEOs about how do you feel about business conditions now relative to 6 months ago. So obviously, if you rewind, 6 months ago, things improved. And it was a feeling of a little bit more certainty, right? But now, with what happened with IEEPA tariffs, I guess there will be a little bit more uncertainty going forward, and that could weigh on the results going forward.
So you would say that the confidence may be dialed back then, just because even though we rolled these back, we now are back to
a lot of uncertainty. I think that will be reflected in the next survey results. I cannot predict it, obviously, but this is my feeling. A lot of what drove the survey up was business intentions, capex intentions. CEOs thinking about investing going forward, and those plans increased.
Well, that's what I want to talk about, too. I mean, I know tariffs and policies out of Washington have been sort of the hanging over a lot of these companies, but I got to think that AI and this whole technology rollout is having an effect, too. I mean, every time, anybody can just, put out a report now with a bunch of hypotheticals, how AI will ruin us all, and then your stock gets sold off. I mean, how are the CEOs sort of thinking about right now how AI either hurts them or maybe even benefits them?
Well, you need to increase productivity. You don't want to be left behind, and that's what's driving it. What's interesting, though, is that they're not planning to hire for that. So it's really, really investment in productivity. And
well, I am curious, though, too, and it's funny you bring that up, because we just had some headlines a while ago from Block, Jack Dorsey's company, cutting 40% of their workforce. And he explicitly says in there that, look, we've got all these new technology tools that allows us to do more with less. And he even says that he thinks most companies are late to this, and basically alludes to the idea that we'll probably see more of this. Now, I know a 40% cut in workforce is extreme by any measures here, but do you anticipate that we could see, if not a reduction in workforce, certainly some attrition in workforce as we go forward?
Initially, but I think that AI will create other jobs, more jobs, like in different sectors, and there will be demand for other types of jobs. I just came back from Washington, D.C., where we had a conference, the economics conference, National Association for Business Economics. There was a lot of discussion around AI, obviously, and I think the common sense is that AI will bring jobs. It's just going to take some time.
Does anyone know anything? I mean, I know these are some of the brightest economic minds, but we heard some of the commentary, including from some Fed members, saying, "Look, it's on our radar, but how do you sort of put that into any sort of rate-making decision or any sort of a policy decision?
I think these kinds of things will take time. And this is not something that the Fed can incorporate into their policy making right now. So it's going to take years probably to come. So.
Well, with that potential capital spending, does that mean companies are ramping up spend on AI tools and just keeping headcount stagnant versus cutting workers and spending more on AI?
That's what it seems like, right? At least according to the survey results, and that's what we see in the data. We do see like kind of flat payrolls if you kind of look it up and average it around, and that's what we see. So I think that's kind of the new reality.
Just real quick, we only have about 30 seconds left, but we didn't ask you at all about geopolitics. I mean, there's multiple wars going on, and I don't know, something happened in Cuba the other day. Is that even on their radar for these CEOs, or is that so far removed from their bottom lines and top lines?
It's on the list of the key concerns, but I guess cybersecurity and uncertainty is probably the most, what concerns people most.
All right. Well, a great report out from the conference board here. Yelena Shulyatyeva, senior U.S. economist there, talking about the latest CEO survey of the largest companies in the world. As we move towards the closing, the closing bells have come and gone. As we move towards the end of the close here, we do just want to recap some of the big moves in the after-hours trade. Dell, they just reported earnings, 11% pop in the stock as that conference call kicks off. Doesn't seemingly, at least for them, no real speed bump here when it comes to their ability to sell more servers, more computers.
Yeah, this is a company, again, that's projecting $50 billion of AI server sales. So that's better than I think most analysts and investors would have expected, and that came before the news on Warner Brothers.
And then you have Block, XYZ, up 22%. Jack Dorsey's company slashing 40% of his workforce because he said, look, we got all these AI tools that will let us do more with less.
And that's a stock that, as you mentioned, we don't have the numbers in front of us, but would be one of the best days in quite some time for a company that has seen its share price plummet from where it was about 5 years ago.
And of course, we are going to synchronize our watches for Netflix, which now has 4 days to respond to the latest news here that Warner Brothers Discovery has deemed that the Paramount Skydance bid is superior. Still, it's that Netflix deal that's on the table. It's their move, and we'll have full coverage of it right here on The Close as soon as it happens. For all your political coverage, stick around. The team at Balance of Power, they're coming into the studio in just a second, right here on Bloomberg.